Good morning, good afternoon, what's up everybody? This is Joel and I'm coming at you with another video. So this video I'm super excited to show you guys. This is how to day trade SPX or S&P. Previously in my last video I showed you guys how to day trade NAS 100. And so S&P is a very similar pair to NAS. Think of them as either like siblings or cousins. They move really similar to one another. And so you can trade both or you can choose one. It's all a matter of preference, whichever pair I guess you like better, the way it moves, how it operates. I think S&P moves a bit more conservative, and if you have a smaller account balance, it's easier to trade this pair, right? You can put on larger lots, while NAS tends to move a bit more aggressively. Um, but I think it's ultimately about preference because both of these pairs move very similar, and you can use the same strategy to trade both pairs. So in this case, I want to showcase how I personally trade the S&P 500. I want to say personally, so if we take a step back, I want to say in the prior weeks, maybe months, I was really more so focused on NAS. But I think now once I started giving S&P a little bit more attention, I actually think I like it a bit more than NAS. So we'll see. I might end up trading probably both pairs, but I definitely want to dedicate time to S&P because I think its moves are a lot cleaner. Like I think it's more obvious when it generates like liquidity pools in terms of like equal highs, equal lows, things like that. So I think it's probably easier for someone to start off trading S&P as opposed to NAS. But in this video, right, we'll go through the process of trading S&P. So at the top right, you see in the black rectangle my trading confirmations. I don't really pay too much attention to that because I pretty much have everything memorized like the back of my hand. But I still have it there as a reminder. So this should help you guys follow along with going through the process. So the very first step that I'd like to do is first highlight to you guys that I'm trading New York time. So if you want to adjust your time zone at the bottom, right, you want to select New York time zone. The reason for this is because the market moves in algorithm, right? So just time and price, certain things happen at certain times of the day. And me particularly, I'm a New York session trader, so I only take trades within the New York and London crossover, which for me, the time frame for that is from 9:30 a.m. Eastern up to 11 a.m. Eastern. I do not take any trades outside of that 1.5 hour window, and there's reasons for that. So we'll just break this down with this one setup because I think this is a really amazing setup that provides a perfect example in terms of how to trade this pair. So jumping right into it, the first thing that you want to do is mark up your liquidity pools on the 15-minute time frame. So what I'll do, I'll go into the 15-minute time frame, and it's important to do this be prior to 8:30. The reason why you want to mark up liquidity pools prior to 8:30 is because at 8:30 is when the hunt begins, which essentially is when the algorithm begins moving to attack liquidity, right? Both buy side and sell side liquidity. So this vertical line at 8:30, this is what I marked. This black candle that I've highlighted right now, at the bottom it says 8:15. So this black candle here is from 8:15 to 8:30. So basically from this point, I look left to see if there are any obvious swing highs and swing lows that we can highlight. So the first obvious swing high and swing low from this point looking left, I mean these are equal highs. So in this case, right, we can do this because these are equal highs, but the most obvious swing high to the left of 8:30 would be this high over here. And a swing high or swing low is basically if price is at an equal high or equal low, I don't count those as swing positions. It needs to be essentially just one point. If for a swing high, for example, this large wick, the candle to the left and the candle to the right needs to be lower, and vice versa. For a swing low, for example, we can look at this candle right here. You're seeing a wick go down. The candle to the left and the candle to the right needs to both be higher for it to be considered a swing low. So in this case, prior to 8:30, right, this candle went up here. These are equal highs, but then this is the most obvious swing. As for the swing low, the most obvious swing low is down here, and I marked them red and blue. Essentially, this red candle here can just be seen as sell side liquidity, and this blue candle up here can be seen as buy side liquidity, right? So now we have both of our liquidity pools marked. So in this case, some of you may see this level here and think, hey, why don't you use this as the swing low? Well, that's because these two lows right here are essentially equal lows. So we can also do this and mark that as liquidity if we wanted to, but I really don't need to. It's super small. So that's why I don't consider this to be a swing low. The next most obvious candle that stands out, that has the left and the right candle that are higher than the lowest point, that's a swing, right? So we have buy side liquidity, sell side liquidity right here. So now what we're going to do, we've already marked our liquidity pools. So now we want to wait for a liquidity grab. So it is possible and usually likely for price to attack one of the liquidity pools. So the beauty of our strategy is, the logic behind it is that we want price to attack one side, right? To take out either buyers or sellers in one side, and then we want to see a essentially break of structure or a reversal going in the other direction to then attack the other liquidity pool, right? So once we see one liquidity pool get purged, if it falls within the time frame that we're looking for, right, we then want to see a break of structure, and then hopefully we're able to take the trade to then take it to the other side. So a simple example is, if price comes up and takes out buy side liquidity, I want to see it break structure lower and then give me an entry opportunity to then take it down over here. Now vice versa, if price came down here and took out sell side liquidity, right, pushed through, I want to see a break of structure going, a bullish break of structure, right, to head up to then take out this liquidity. So what we'll do is we'll just drop to the lower time frame, right? We'll just jump into a 1 minute to see what happens. So right now, this is the 8:30 candle, right? So you're seeing the 8:30 candle, of course, clear these highs right here, but it, and you know, it took out this liquidity pool here, but it did not take out this liquidity pool over here, right? It pretty much almost delivered, like on the 5 minute, right? It pretty much almost delivered like a double top. So retail sees this and they start selling. However, we're not jumping in a trade, right? Because we only trade from 9:30 to 11 o'clock, and right now it's only 8:30. So we're just seeing what price does, and we see at 8:45 price delivers us a perfect double bottom, right? So what price is doing now is engineering liquidity on both sides. So people, retail traders, seen this up here, right, and they thought, oh, this is resistance, and then other traders seen this here and they say, oh, it's support, right? So the market is essentially inviting traders on both sides to enter, but what we're doing, we're actually waiting for the liquidity to get taken, so then we can see if price delivers us an entry. We don't want to see both liquidity pools get taken out. We want to see one get taken out first in order for us to then enter. So as we keep going, right, this is the 9:30 candle. So the reason why 9:30 right here, this purple line right here, so the reason why 9:30 is also important when trading NAS and SPX is this is the New York Stock Exchange open. So this is, you can expect volatility to come into the market once 9:30 hits. So that's why we want to wait until after 9:30 to take our trades, because we want to see what the volatility does. If the volatility ends up attacking either of the liquidity pools, which in this case it doesn't, right? It's just a bullish candle. well, now right here we see at 9:35 to 9:40, we see a massive, massive push up. So once I see that push up, I like to mark my things, right? Like I like to mark whenever liquidity gets taken. I like to mark structure points, right? So I sort of have my steps in line, and then I'll know when to take a trade because it's sort of hitting all my confirmations, right? So the first confirmation, we marked all liquidity pools, check. Next is the liquidity grab, which you see right here. Price came up and dipped into the buy side liquidity, buy side liquidity. Um, so this was our liquidity grab. So now, once liquidity gets taken, you want to find the last point of structure that was formed before the liquidity grab. In this case, the last point of structure would be here, right? And I like to signal this with a light bulb. The reason why I have it here is because these two candles right here, these are equal lows, which do not count in my eyes. And then once again here, these two candles are equal lows, which do not count in my eyes. This is the last swing. So in theory, if price doesn't make another push up and if price goes straight down, then I would need price to break this level of structure before I even consider looking for an entry. Obviously, it needs to leave a fair value gap, which I'll explain what that is, which essentially it's an imbalance, right? This is an example of a fair value gap, which price was just delivered on one side of the market and we want it to tap into the other side. So that's what we would use as an entry. But in this case, price pushed up and this was the last form of structure. So what I would like to see, because this is super far from the liquidity grab, I would love to see price, maybe retrace a bit and then give us another push up. And I'll just show you guys with where is it, with a brush, right? So I would love to see something like this, right? Push up and then that blue, right? So I would love to see price retrace a bit, go back up, and then push down and break this last structure point. So then what we can do is then take an entry at a fair value gap and head down. So that's sort of the crude drawing of what I would like to see, but we'll let price play out. So we're in the 1 minute candle because we want to see price action. So we have a black candle there, a small push down, price to move. Okay, boom, right here. So once we seen this high get cleared, right, this one gets taken out, we now see this is the last structure point. So at this point, I just move my light bulb right here. So this is signaling once price breaks this level, that's considered a break of structure in my eyes. And then of course I want to see the fair value gap form. So now we're just being patient. We're just letting price play out. Right, it's still going up and up. Notice that these two candles are equal lows. So although we're still going higher and higher, these are equal lows. So I do not consider that to be a structure point. I would still leave the structure point right here. Now we pushed up. And once again, this level got broken, but these are equal lows. So I don't consider this to be a break of structure. I still consider this to be bullish trend. So now, right, we'd still want to see either the break of structure lower here, or just another push above. Sometimes I like to mark things up, right? So just wait for another push above. In this case, we just want to see what price does. Perfect. So now with this push above, right, our last swing low is right here. So we move the light bulb right here, and then we're hoping to see a break of structure lower, right? Because if this liquidity pool got taken up here, our buy side liquidity, we're seeing equal lows down here that we want to target as our final target. So candle here, and now we see an aggressive bearish candle, and boom. Once this candle pushes below, even if like the candle is right here and a wick starts forming, the second it crosses under this level, immediately I consider it to be a break of structure. And now the other key component is we want to see a fair value gap, but not just a fair value gap forming anywhere. We want to see it form between the displacement high and the displacement low. So what I mean by displacement high and displacement low is we want to see a fair value gap form from, in this case, we were bullish and then broke structure bearish. So we want to see a fair value gap form within the range of the displacement high, which is the highest point, and the displacement low, which is the lowest point of structure before the break of structure. So in this shaded area is the only space that I'm looking for a fair value gap to form. If a fair value gap forms outside of this space, which let's just say there's like a gap right here, right? I wouldn't take it. It needs to be within the gray shaded box, which we clearly do see one right here. And of course, I've highlighted it pink for you so you can see it clearly. This is the gap that formed between the displacement low and the displacement high. So with this fair value gap, this is where I would take my entry. One key thing to note is with the fair value gap, I really only look for these gaps on the 3-minute, 2-minute, and 1-minute time frames. So in this case, if I go 3 minutes, nothing. 2-minute, there's nothing, right? But the 1-minute is clear as day. We see a big gap in price, just bodies being formed. So this was just sell side offer, right? You just see black candle, but we are expecting price to retrace back and offer buy side at this level. So once I see this gap form and then the break of structure, you know, this was a sudden rapid movement. You're seeing displacement because you're seeing such aggressive candles. For me, that fits my confirmations to take an entry. So I like to mark up I like to use horizontal raise, so it gives me the exact price and the exact the price where I'm gonna enter and the stop loss. In this case, I like to put the stop loss at the highest point, right? And if we were taking a short, it would be at the lowest point. So we just, you know, for a short, you would just flip it. But this would be the trade I take, right? 26 pips on the S&P. Take it right here, and this massive candle down, it's 10 o'clock, which is perfect because I would have my limit order set at the entry of this candle right here, where you're seeing. I would have my limit order set at this point, and I would keep my limit order in place until 11 o'clock. If a trade activates, you know, before 11 o'clock, then that's great. If 11 o'clock hits and we still haven't entered this trade, then I would just delete the limit order and, you know, my trading day will be done. So because we're expecting for these things to happen between 9:30 and 11 o'clock, which this massive move happened at 10. So now we have our limit order set, our stop loss in place, take profit where this is our final target at the sell side liquidity pool, which you're seeing equal lows right here, or in other words for retail, right double bottom. So we have that there. So now we simply just wait for price to tap us in, which it does at 10:02 a.m. So super tight stop loss, but you really don't need a larger stop loss. Maybe, you know, if you want to account for spread, you could move it up like another like pip or so. But in this case, for me, I don't need the stop loss to be any bigger than it needs to be. So this is the trade that I'm taking, and you know, it's great to trade with the stop loss because if price blows past this, then our analysis was incorrect anyways, or it could have been right, but the market just didn't want to give us a trade. So in that case, there's no point in being in the trade, right? So that's why we put our stop loss where we do, right? We put it at a very logical location after liquidity has been taking and a break of structure was delivered, right? There's very, I don't really see a reason to be in a trade if price takes you out. Like, you don't want to be in that trade anyways. So the stop loss is actually there to help us, right? It's to help stop our loss. So once we get tripped in, now we can look for other potential targets. For me, I see an obvious target right here, which is the most immediate sell side target. This is like low hanging fruit, because if price comes in and takes out this first level, I would immediately move my stop loss to break even, because one sell side liquidity target was taken, right? Price could come take out this target and then decide to um, be bullish. It doesn't have to go and target this area down here, even though this liquidity pool would make it a high probability setup. Price doesn't have to come down here. They can leave that for another target. They can leave that target for another day. So we just want to um, essentially take advantage of what's highly probable and also protect our accounts, because protecting your position is the most important thing in trading. Protecting your account, protecting your balance, right? Without capital, you really can't do much in this market. So you want to protect your capital whenever you can. So at this level, if price were to come down, I would immediately move my stop loss to break even, and now also take partials, especially because it's a tight stop loss. So this level right here is a 1 to 285, so almost a 1 to 3. You can easily take off 50% of your position and make good profit. You do a target here, another obvious target here, which is another swing low. You also have fair value gaps here. So it's all how you want to approach it, right? You can also go on a 5-minute, right? You see a massive fair value gap here, so you can take it at the beginning or like at the 50% mark. You have plenty of opportunity to take partials, but if you want to keep it simple, right? 50% at a 1 to almost a 1 to 3, and then you could take off 80% or like 30% more off here at a 1 to 4 as well. So at this level, you could have probably 80% of your position closed, or you could take off 50 here and then the other, and just leave the rest going to this last target. Is however you want to approach it. But anyways, once we get tripped in at 10:02, right, we now see that this level was rated. So at this point, we'd eventually move our stop loss to break even, and then this would be a risk-free position. Hopefully you take some partials right here so it can be a win for you, and then you just let the rest ride out, and then you can continue taking partial profits as price moves down. So as we continue, right, you see that price just shoots down and ultimately, right, obliterates sell side liquidity. So with this push down here, this clears the liquidity, but price will keep pushing down. So this was an absolute beautiful textbook setup, and I wanted to present this setup to you guys so you can see how the market operates. Like when I was a new aspiring trader, just learning as much as I can, all these different strategies, things like that, I always questioned why 90% of traders lose 90% of their capital within the first 90 days, right? I always thought, like, wait, if you can only buy and sell in this market, in theory it should be 50-50 to win or lose, but the majority of people are losing, and I never understood that. I definitely experienced it, I'll tell you that much, right? Like the market was definitely borrowing some of my capital, but it's because the market plays both sides, right? Like it manufactures opportunities, right? Because it's well aware of double tops, double bottoms. So it manufactures these opportunities to get traders in, right? In this case, a lot of traders were selling here, or if price came up here, you had your breakout traders buying, right? Other traders here were buying, and then other traders here put sell stops in case they were anticipating price to go down further from this level. And you see here the market literally plays both sides. It comes up, it attacks buy side liquidity, and then it delivers a break of structure, and then absolutely melts and takes out the sell side liquidity. So it's taking out all the traders, it's taking out traders on both sides of the markets. Now for us, the way we see the market, we're patient traders, right? We wait for the market to deliver, to for the market essentially to show us its hand. We want to see what it's looking to do, and then if it gives us the pattern, right, the signature that we're looking for, we take the trade. And in this case, right, this would have resulted in a win, because even though, you know, these candles came close to our stop loss, it didn't tap our stop loss, right? Like our stop loss would be here, or, you know, slightly above this level, which clearly it didn't, and it just completely melted, right? So, and we would take partial along the way. So even if price came down to this level or this level and then just decided to reverse against us instead of clearing this last target, we would have still taken partial, so we still would have walked away with profit. And you know, obviously our account would grow. So this was just one simple example of how I trade, right? It's just waiting for liquidity to get taken out and then waiting for a break of structure in the other direction and then entering at a fair value gap. So if price does not deliver a fair value gap, then you don't have a trade, right? Say for example, right, we just seen like wicks, or like the bodies were covered. Like in this case right here, you're seeing a lot of wicks and then there's no body. If that were to happen, then there wouldn't be a trade. We would and I'll just rewind it so I can use it as an example, because this is actually valuable knowledge that I had to learn through trial and error. Like I had to like figure this out, sort of like, I guess you could say, on my own, right? Because it wasn't like explicitly told to me. So let's just say these wicks were long and no bodies were exposed, but we seen the break of structure. If we seen this break of structure, then what I would do, I would put this horizontal ray right here and wait for another push above. I would just wait for another push above. And then if price were to deliver us another push, right? Say for example, right, this was covered, there's no fair value gap. I would, and let's say this bullish candle pushed above this high, I would then use this as the low and then wait for a structure break under this low to then take the trade. So that's pretty much it. That should hopefully help you guys, you know, if you were looking for a strategy as an intraday trader, because I don't scalp, I don't swing trade. This is what I do. I show up to the markets Monday through Friday on days where I should be showing up, because there's some days where there's news and things like that that I just avoid, right? It's as important as it is to know how to trade, you also need to know when to and when not to trade. Those equally as important, which I can definitely touch upon in another video. In this case, I just wanted, with this video, right, I wanted to show you guys the process of how I mark up my charts and what my trades look like. Right, so it's set up right here. Mark this up quickly for you guys. Right. So this is what my setups look like, right? We took the trade right here, and then it came down and hit our final target, which the final target is a 1 to 9. I personally don't like holding trades to the final target, like as a full position, because once again, you just never know whether or not the market is actually going to go down there or not. This is highly probable that it would, because it's a double bottom, right? There's a lot of liquidity there built up, so you can expect the market to do it, but it doesn't guarantee that the market will do it. So you just want to take your wins as they come, right? And you're better off taking partials along the way and growing your account, as opposed to just like risking taking it to the last target, right? Because there's gonna be plenty of days where the market doesn't hit your final target. And the importance of taking partials is so that you make money, because we're not in this industry to be right, we're in this industry to make money, and that's the goal. You can make money without being right 100% of the time. No one's gonna be right 100% of the time. You're gonna take losses. You could probably be right 50% of the time, but in this case, right, it's just, we can still make plenty of money just taking partials, like, and you know, having our trade partially complete towards a full target, as opposed to hoping and depending on that it'll get to the end every single time, which I don't think would be super realistic. But in this case, right, you're seeing that both liquidity pools get taken out and you're seeing the market deliver. So this setup here of a breaker structure, oops, put it back right here. You're seeing this setup right here of a breaker structure, fair value gap entry, and then price delivering in the opposite direction. This is the behavior in price. This is what the market does day after day, week after week, month after month, right? So you just want to be keenly aware of this, and hopefully you adopt this as your strategy, because this strategy is originated from ICT, and I dedicate a lot of time into his content, which allowed me to learn this and understand this for myself, and I'm already seeing the results. And honestly, I can't see the market any other way than this, right? Like, learning his content and his material is what allows me to see the market differently through these lenses, and it helps me realize how I used to lose back then, because I used to be like pretty much trading sort of semi-retail concepts, semi-liquidity concepts, but I would lose a lot and it never made sense why. But now there's a lot more clarity into the market, how it moves, and just being able to understand and take a high probability setup. So if you found this video helpful, leave a like, comment, subscribe, turn on post notifications if you're new. I definitely want to keep pumping out content, because trading, I've been in the market for over 3 years now, and I've had struggles finding profitability or a strategy that I was comfortable with, that I had confidence in, that I felt worked. But this is something that's mind blowing, and you see this happening every single day. Even if like on news days, more often than not, when there's like big news events, you'll see both sides of the market, like both equity pools get taken. Even if it doesn't deliver like a fair value gap entry, you'll see both sides get purged, right? So this stuff repeats. Like, this is literally how the market's booked. Like if you learn this, you'll pretty much be set for life, right? You just have to make sure you're diligent, that you show up to the market, and that you have discipline with your strategy, and that you're patient, and in order to wait for these setups to form. So I'll just leave it off here. If you found this helpful, it would mean a lot if you can leave a like, comment, share this video with anyone you think would find this helpful. I just want to put out content about trading and really help people, because I've been doing this for several years now, and I'm definitely working my way up, and I feel like things can only go up from here. So thank you guys for tuning in, and I wish you the best. Till next time, I got more content coming soon, so peace.